Hi guys, we're rolling again. This is Krista. I just wanted to, I'm still using my phone. Okay. So anyways, this is my take two. I'm trying to do this well. And this is my take two of part three of the Tractor Supply stock evaluation. I'm trying a few little things to improve my content here. Going to try some different editing techniques, putting it together differently. I have a cozy filter on my camera, my phone camera, and I'm still holding the camera with my arm, so my arm is probably going to be tired, and since this is my second take, it is going to be very tired by the time I'm done with this video. But anyways, I just wanted to repeat this and we're going to go through these metrics again and we'll see which one ends up being a better video, my first take or my second take. So again, I have no makeup. It's 6:30 in the morning. I don't do makeup at 6:30 in the morning. I wanted to go into my metrics here that I discussed in my last couple of videos on the evaluation of the stock for Tractor Supply. Metric one was the stock compared to tracking an S&P 500 index fund over time. When I looked at Tractor Supply compared to the index fund VOO, which is an ETF, which is the Vanguard ETF that tracks the S&P 500, VOO was outperforming Tractor Supply. So that was the first metric I covered. If you want to go with something that's going to return on investment greater, according to that metric at this point in time, I would have gone with VOO and not Tractor Supply. However, that may change in the future because past results are not always predictive of the future, and the stock market has been doing very good since VOO tracks an array of stocks, not just one stock like Tractor Supply. That metric or that ETF is going to be a lot less volatile than Tractor Supply, which may have its ups and downs depending on what happens. So there is power in diversification, and in that respect, I would have probably chose VOO over TSCO, which is the ticker symbol for Tractor Supply. Metric two is the 5-year average return on invested capital. We want a 5-year average of return on invested capital over 10%. And in that case, Tractor Supply did very well. It also outperformed the index. I think it was, I'd have to look at the video again to see what it was, but it was significantly over 10%. Metric three, a PE ratio of around 15. Tractor Supply was around 20 the last time we checked. So it's a little higher than what I would like as a price earnings ratio. And a PEG around 1. And again, Tractor Supply was higher than 1. If you can get a PEG ratio around 1, that means that the company is growing very well. The price is staying fairly low, and that is a really good buy. Metric 4. Aim for a price over book ratio of 1.5 or less. That means that the total assets of the company, if you liquidated the company and you had a price over book of 1.5, you would pay about 50% more for that company than you would get if the company was totally liquidated. And Tractor Supply was like 7, so it's significantly priced higher than its book value. So yeah, probably at this point I would not buy it compared to that. And you just want to make sure, I mean, there's other things that go into the intrinsic value of a company. There's the fact that Tractor Supply doesn't have a lot of competition in its area with respect to other public companies. So that's a good thing, and that might boost the value of that company as compared to its book value. However, 7 is pretty fairly high. Metric 5, aim for debt over equity ratio of less than 1, or actually 50% if you want to be very secure. And that is a metric. You want to make sure that the company is low on debt. You don't want to have the company have twice as much debt as it is valued at. I mean, as much as it's worth. That means it has twice as much debt as it's worth. And basically, that's what happened with Tractor Supply. It's got a debt equity ratio of 1.95, which is almost twice the amount of debt as its equity value. It's not good. So anyways, those were the metrics I've covered so far. I'm going to cover 3 additional metrics, so for a total of 8, and we'll go into that on the computer. I just want to also let you know that even though you go through these 8, and if the 8 look really good and you're thinking you're wanting to buy, you may want to do some more investigation. Warren Buffett does a lot of investigation on stocks. He looks at the annual report. Also, what you want to look at is the 3 financial documents that go with every public company. That would be the income statement and the balance sheet and the statement of cash flow. You want to look at those. Those are accounting documents that are required by every public company. And mainly, the underlying thing of all, you want to make sure the company is profitable. I do not invest in unprofitable companies. They may be a new company. They, like, these marijuana stocks are coming out, and everybody's like, oh wow, let's get into this new industry, but there's a lot of factors that go into that. First of all, marijuana is not federally legal currently still. I mean, it's legal in some states, but it is not legal across the board. And most of these companies are just starting out. They don't have any profits. They are spending a lot of money. Maybe they're getting some investors that are helping them out, and maybe they have cash to spend, but they are not making money, and they probably won't be making money for a while. And there's just too many factors right now in that industry to make me want to invest heavily in that industry. It's just too risky for me. Maybe for somebody that likes to do day trading, that's different. But as an investor, I stay away right now from marijuana stocks. I do have one. It's called, I can't even think of the name of it. I think it's Innovative Properties, and it's actually a REIT that has a customer base that is marijuana growers. But that is the only profitable company in that industry at this time, and I can't remember the ticker symbol right offhand, but maybe that's something to look for in a future video. So with that, I'm going to go and look at my metrics on the computer. Those 3 metrics I'm going to research, and then we'll go from there. Hi everyone, I'm back. Here I'm got the Morningstar site up, and I will be going into my additional metrics. As I said, I have a premium site, so I do get a little bit of information more than what you would get with a free site. Metric 6 is the current ratio. We want a current ratio over 1. So I'm going to go into the financials here. And current ratio is a liquidity ratio that measures a company's ability to pay its short-term obligations, or those due less than a year. And the formula would be the current assets less the current liabilities. So in Tractor Supply's case, we have a current ratio of 1.6. That's a good sign. That information is from the balance sheet here. We've got a little summary here, but we don't have we have the total assets and the total liabilities, but we don't have the current assets and the current liabilities. If I go into the balance sheet, we have information over time, and that's why I like Morningstar, is because it has information over time, where many of these sites just have the current information. I like a site that has at least 10 years of information. That way you can just see how the company has been doing over time, and it's an indication of how consistent their performance is. So in 2018, we had current assets of 1.79 billion, and we had current liabilities of 0.03. So that is really a good current ratio. Tractor Supply is good in that respect. Incidentally, most of these definitions that I'm getting for these metrics I found in a site called Investopedia. I'm going to go ahead and go over there just briefly. This is the Investopedia site and the information on current ratio. It's got all this information on it, what the formula is. It's even got a video on current ratio and interpreting the current ratio. So this is a wonderful site for information. It's also got classes. I believe most of these are paid classes, but it's a great site if you want to get more education on markets and financial information. Metric 7 is the free cash flow over net income, and we want that greater than 1. So for that metric, I will go back to the operating performance. This is also where I found the return on invested capital metric, as you can see. But we're going to go down all the way to the bottom of the site here. And in 2018, we had a free cash flow over net income of 0.78. We want it greater than 1, and which would indicate that the company takes in more cash than it earns in profits. And this definition I will credit to a blog post that I found on the internet by a person named Alan Lee. We will go over there briefly. The name of the blog is BizFluent. This is more of an accounting blog. I don't think it's related too much to investment, although it does help. And this article by Alan Lee has a whole lot of information on cash flow, the relationship between cash flow and net income, and the interpretation of the ratio. So I am going to give credit to Mr. Lee. I am probably not going to put the URL in the video, but I may put it in the show notes. So if you're interested in this information, you can go to the show notes and access this. My 8th metric is technical analysis. Well, actually, a couple technical analysis metrics. And I just wanted to briefly make a statement about technical analysis. I consider myself an investor, so I do like to look at the fundamentals of the company before I buy the company, and not so much, I don't place as much value on the technical analysis. Technical analysis is basically analysis on the stock price. It's often used by day traders and others that are looking to make a quick profit and not looking for an investment long term. But the reason I do like using a couple of metrics in the technical analysis is because sometimes it gives you a good indication of when would be a good time to buy the stock. So for this, we are going to go back into the chart. I'm going to go into this full chart here. And there's two of them that I really like. I'm going to go for a year time because that takes into account that little dip that we had at the very beginning of 2019 and the end of 2018. Well, so anyways, that's what I'm going to look at. And I'm going to go into the events and indicators here. We're going to look at the Bollinger Bands, and we're also going to look at the Relative Strength Index. Now, there's a lot of other metrics here that many of the people that are interested in technical analysis look at. One very popular one is the MACD. I have read up on some of these. Some of them are a little bit complicated, but I do like the relative strength index and the Bollinger Bands because they're fairly easy to understand. For the Bollinger Bands, I'm just going to use the default period and deviation. And this is what I get. I'm going to click in here. So as you can see, with the Bollinger Bands, the current stock price is towards the low end of that boundary, which indicates that that's a pretty good time to buy. It's towards the lower end. If it gets up to the top, that may indicate that the stock has been oversold. Same thing with the RSI. So the range of RSI that you basically look at is between 30 and 70. If an RSI, or relative strength index, is lower than 30, that means that stock has been oversold and it's a good time to buy the stock. If the RSI is over 70, that means that the stock is overbought and it is probably not a great time to buy the stock and might even indicate that you might want to sell the stock. I'll put it right here and I can see over on the very left side what it's at. It's at 39.49. However, like I said, these technical indicators are not a super reliable metric to look at when you're buying and selling stocks. Sometimes a stock will have momentum due to something that happened for the stock, like let's say they developed a new product and that momentum will send the RSI over 70. My dog's barking. And it will still continue to go past that even though the stock appears to be oversold. So just a little bit of more information as to when you might want to buy the stock. It's not necessarily always the case. Okay, so the next thing I wanted to go through, and this is like a little add-on here, is I wanted to go through the beta. Beta is an indication of risk, and if a beta is 1, that means that the risk is pretty much the same as the market overall. If you get a beta that's less than 1, that means that the stock is less risky than the market overall, and a beta greater than 1 would mean that the stock is more risky than the market overall. A beta of 0 is basically cash. There's little risk, no risk. Well, there is a little bit of risk with cash because you have inflation, and so that will erode the value of cash over time, but it's pretty steady basic risk level. And then the market, of course, is the market. So Tractor Supply has a beta of 1. I tend to be conservative, so I like companies that have betas less than 1. However, if you have a growth company, a lot of times the beta would be higher than 1, or a small company, the beta would be higher than 1 because the changes in the market will affect that stock greater than it will with an established company. I just wanted to go a little bit into dividends here too. Dividends do affect the value of the stock over time because if a company pays dividends, there's not as much money to invest back in the stock. A company that retains its earnings invests most of the profits back into the company. Usually established companies will pay dividends, whereas new growth companies retain their earnings because they're trying to grow the company. In Tractor Supply, they do have a dividend. They pay a 1.4% dividend. It's like 35 cents every quarter per share. They have a trailing dividend yield and they have a buyback yield. Buyback is when the company will buy back shares of their own stock. And usually what that means is that they will be attempting to increase the value of their stock, and that's a good sign. The other thing you want to pay attention to is the payout ratio. Tractor Supply looks pretty healthy in this respect. It's got a payout ratio currently of 28.95%. You do not want a company that pays out a greater ratio of its dividends than it takes in earnings. That would mean that the company is cannibalizing its value, which is not a good thing. Occasionally you will see this with perhaps a newer company that is trying to get investors, or a company that does not want to cut its dividend, because what happens when they do that is that people just start dumping the stock. So people like to rely on these dividends. It's a little bit of extra cash in your brokerage account that you can either keep or you can invest again. And so it's always nice to have a company that pays dividends. And regardless of the value of the stock and the value of the market, it's really nice to have a little bit of passive income coming in quarterly. So that's basically it for my metrics here. Other things you want to look at, of course, you don't want to choose automatically based on these metrics. You still want to do some more investigation. And you want to make sure that your company is profitable. If the company is not profitable, that means they're not making any money. I like profitable companies. Some people like to invest in companies that are just up and coming and are growing and are not making profits. But for me, as an investor, I'm fairly conservative. I do like to make sure that my company that I'm investing in is making a profit. And also, you want to look at the 3 financial documents that are available for every public company. That would be in the financials here. Go back here. Morningstar has a great summary on these, and you can go into each one of these for more detail. We went into the balance sheet earlier. But this would be the income statement, the balance sheet, and the statement of cash flow. And these are 3 documents that every public company has to file with the SEC. You also want to look at the annual report. And just keep in mind that the annual report is kind of a sales pitch for investors. It's put together by the public relations portion of that company. And it tells you things that are on the horizon, maybe new products that are coming out, new locations that are coming out, or if the company hasn't been doing well, maybe some sell-offs and realignment stuff and downsizing stuff. But just keep in mind that it is a sales pitch, so if there's an indication that the company is not doing well in its annual report, that is probably a big red flag that you do not want to buy that stock right now. And there you have it. That's basically what I look for overall when I'm evaluating a stock. I hope you enjoyed this video. If you did, feel free to press the like key for the YouTube algorithm. We always appreciate that. And if you want to see more of these videos, you can subscribe to my channel. And if you'd like to be notified whenever I post a new video, hit the bell. That's it for me today. Hope you enjoyed this, and it's time for me to sign off. Stay inspired. Bye.